Hello all, welcome to today's session on tax planning and investment. My name is C.A. Shokot Roy and I have been a part of CLEAR for 4.5 years now. In today's session, we will be joined by Rahul, who will be operating the chat box. Rahul is a qualified professional and has a huge amount of experience in the field of taxation and company matters. So if you have any question during the session, please drop questions in the chat box so that he can answer those questions. Now, let's take a look what are the topics that we are going to cover today. First and foremost, we will understand who should be planning for the investment and what is the fundamental behind investing. And later we are going to look at various investment options that are available, and we will understand what are the importance of choosing right regimes and declaring incomes and expenses. And finally, we are going to discuss about something that we must keep in our mind during the entire year. Now, firstly, let's look at who should be planning for investment and declaring their incomes. Now, first and foremost, let's try to understand what is the purpose of investment declaration. Now, we as salaried employee, we are supposed to pay taxes on our total earnings, right? Be it salary, be it interest income, dividend income, capital gains, whatever it may be. However, there are certain tax saving opportunities available in our hand with which we can reduce our taxable income. And if our taxable income goes down, the tax payable on it goes down as well. So, if my income is beyond 5 lakh rupees, I should be declaring whatever tax saving investment or expenses I may have. Now, here's the interesting point, that is, income should be more than 5 lakh rupees to be effective to reduce taxable income. Why is that? Because as we all know, if my income is more than 2.5 lakh rupees, I am supposed to file income tax return. However, few years back, the government actually has come up with this declaration that if my income is not more than 5 lakh rupees, then even though tax will be calculated on that income, the same will not need to be paid by us. Instead, the government will give us a relief so that we are not supposed to pay any taxes. Filing the return, yes, most definitely it will be required, but paying the taxes, it will not be required. Therefore, if your income is not more than 5 lakh rupees, then declaring the investment will not yield any good result, or rather any result. Second point is, if a person is opting for old tax regime, in that case, income tax declaration is absolutely needed. Presently in India, there are two tax regimes. One is the old tax regime, another one is the new tax regime. Under the old tax regime, you are supposed to take benefit of all the tax saving investment and expenses. However, under the new tax regime, you are not supposed to take any of such tax saving investments benefit. The flip side is, under the old tax regime, the tax slabs are quite big, right? Every incremental income would result in 15% or 10% of tax hike. Whereas in the new tax regime, every 2.5 lakh rupees of increment would attract 5% of tax increase. Now, this may seem a little off, but we are going to have a detailed discussion on which regime might be beneficial for you taking in certain situations. Further, what needs to be declared, right? So there are a lot of tax saving investment and expenses available for us to claim. For example, life insurance, home loan interest payment, home loan principal payment, rent paid, etc., etc. Implications of those we will be seeing at later part of this webinar. Furthermore, another thing we must be declaring or we need to be declaring is if we have any sort of income originating. Now, as of now, whenever we say declaration to your employer, our mind automatically goes to the tax saving investment, right? However, there is one option to declare the incomes as well. Many people do not really exercise this option. However, there is a key benefit if you declare your additional income to your employer. See, if the tax payable after taking all the TDS and reliefs is more than 10,000 rupees, in that case, you are supposed to pay some amount of advance taxes. Now, if you do not pay advance taxes, a rate of interest is charged upon the tax due amount. And if you are paying that amount at the time of filing your income tax return, it can become a big sum. Therefore, if you have certain FD interest coming in your way, dividend income coming in your way, it's better you take a little bit of cognizance and declare that dividend income or other sources income to your employer. Now, let's try to understand why should one be investing. The first answer is very clear in our mind that we need to be saving the taxes, therefore we should be investing. So we are not going to indulge too much on this fact. However, there are certain items we need to be looking at. Firstly, saving for the future, creating wealth and asset creation. Now, saving and investing should not be seen separately. If you are saving a certain amount, you should be investing that amount into a asset class that you choose. Right? It can be FD, it can be ELSS, mutual fund, shares, whatever it may be. But you should be investing. Why? In future times, it is uncertain, right? So therefore, you should be investing. Finally, one thing, this will be a little bit out of the box thinking for you, that reducing unwanted expenditure. At the beginning of the month, whenever the salary is credited to our account, we see that our bank balance has a certain comfort attached to it, right? So what we do is we just go out and indulge ourselves. Maybe a couple of weeks back, I have seen a good watch that I wanted to buy, but there was no fund available with me. But now, at this point of time, I just received some amount and going ahead and buying that watch. Now, this scenario might be a bit too familiar for any of you. Instead of buying an expensive watch, what you can do is you can invest the money in some place. Obviously, you may end up having an expensive watch in your collection, but you could be investing in a really good ELSS fund, which could give you tax benefit as well as help you to create some wealth in future. And since you will not be having any amount with you to spend, your unwanted expenses can also be curtailed to a certain extent. So these are the some key issues or other key points which may save you some taxes. Now let's take a look on tax saving on certain expenses. Now, Whenever we are talking about tax saving expenses, the first thing that creeps up is house rent allowance. The basic idea is if you are staying in a rented place for your employment purposes and your employer has given a certain allowance to meet that rent expense, in that case, you can just go ahead and claim house rent allowance. However, there are certain conditions we must keep in mind before claiming house rent allowance. First and foremost, your salary must have a allowance as house rent allowance or HRA embedded to it. If HRA is not a part of your pay package, then HRA cannot be claimed. House rent allowance cannot be claimed. Second point is many of us are under the notion that any amount of rent that I'm paying, it can be claimed as house rent allowance, or rather the amount of rent that we are paying, the entire sum will be deducted from my salary as house rent allowance. However, that is simply not the case. To get to know about the exact amount of deductibility from your salary, you need to look at three figures. Number one, 40% or 50% of your basic, actual amount of HRA that you have received, and actual rent you have paid minus 10% of your basic. Out of these three, whichever is lesser, that will be your HRA, house rent allowance deduction. The implications with the numbers we will see at a later point of time. Second point, excuse me, that should be coming up your mind is leave travel allowance. Now, leave travel allowance or LTA is a very useful tool to save some of the taxes. Now, LTA is given to you if you are traveling and if you have taken train or plane to reach to the main point. However, there are certain conditions as well to claim leave travel allowance. Firstly, leave travel allowance deduction is given to you twice in a block of 4 years. Now, the recent block has started from 1st January 2022. So we right now are in the middle of the or rather we are in second year of the block. Secondly, the travel must be within confines of India. It should not be a foreign travel. Thirdly, only to and fro expenses, either via train or via economy flight, can be deducted. If you are traveling via car or bus, those deductions are not really available. Only train and plane. If you are traveling via train, then make sure you are traveling either AC 3 tier or 2 tier or AC first class. If you are traveling via flight, then make a note that only economy flights are available. The proofs for these purposes can be the ticket, or if you are traveling through plane, then ticket and boarding pass as well. What other expenses? Now, these expenses that we are going to talk about are actually part of flexi benefit. Now, most of us work in an organization where there are several components in our salary. If we look at our basic, one part is basic, another part is your house rent allowance, and a chunk of the money is parked in something called a special allowance or other allowance. Now, at this point of time, we are free to allocate the other allowance bucket to any specific other allowances. And most of us don't really use this benefit that we can shift some amount from our other allowance bucket to any other specific allowance. Now, if we do that, if we take certain amount of time to understand and allocate, it can save a good amount of taxes as well. For example, food coupon. Now, as per income tax rules, as per Income Tax Act, if employer is giving or option to get food, they can do so. But maximum amount that can be allowed is 50 rupees per meal, and maximum 2 meals in a day is allowed. Therefore, what they do is they give you a certain amount in wallet or any specific card. The amount is particularly set aside to be spent for fooding purpose, right? You can go ahead and buy groceries, or you can go ahead and buy some food in restaurants or anything. But that amount is all that amount can also be separated. Now, if you come to think of it, if every month you get a tax-free allowance to buy groceries, wouldn't that be wonderful? The food allowance, food coupon is just like that. You can go ahead and purchase some atta, dal, etc., and it can save you the taxes. But the maximum amount it can have or it can be allocated is 2,200 rupees per month. Further, since the lockdown has lifted, people are going to office. And to reach office, people often use motor car. Right? So if you allocate certain amount to running and maintenance of that motor car, that amount can also be taken to a certain extent as tax deductible expenses. Therefore, if you have the conveyance allowance embedded or traveling allowance, then you can certainly allocate certain amount of money for petrol expenses of the motor car. Further, uniform allowance is there if your employer is allowing that. So you can purchase some clothing item and you can get it reimbursed, and it will become tax exempted. Now, another tax saving expenses is your interest on home loan. Now, interest on home loan has a really interesting component. So every month, or rather every year, if you have taken a home loan, then depending on the purpose of that house, either 2 lakh rupees or the entire amount of interest can be deducted from your excuse me. However, if the property, the house property that you have is a self-occupied house property, maximum 2 lakh rupees per year can be deductible, right? If this house property is let out, that is, if you have rented out this house property and earning some rental income, then you can deduct the entire amount of rent. Entire amount of interest from the rental income, and in turn, you may end up having some sort of housing loss. We will, at this point of time, stick to self-occupied house property. Now, one thing must be noted over here: to get the interest on home loan benefit, the house must be completed and it should be possessed by you. If the house is not completed and possessed by you, you cannot claim the interest benefit, whatever amount of interest that you have been paying. However, it will not be going to waste. Why? Because any amount you are paying, that can be accumulated. The interest component can be accumulated, and once the house is completed, once the house is possessed by you, you will get the benefit over a period of 5 years in equal installments. For example, you have booked a house which is still under construction in 2020. The house took 2 years to complete, and for each of those years, you have been paying 1 lakh rupees of interest. All in all, 2 lakh rupees. Now, in 2023, the house is completed. And in 2023, you are paying 1 lakh 30,000 rupees of interest, right? So in 2023, you will be taking 1 lakh 30,000 rupees of interest for 2023 plus 1/5 of interest that you have paid during the construction period, which will be 40,000 rupees. So you will be able to take 1,70,000 rupees in the year of its completion. However, it must be noted that maximum amount of interest that can be claimed for self-occupied house property is 2 lakh rupees. Let's try to understand this with an example. Say for example, I have paid 2 lakh rupees in 2 years, which is giving me 40,000 rupees of interest installment. But this year of occupancy, I have paid 1,90,000 rupees of interest, right? So 1,90,000 rupees for current year plus 40,000 rupees for previous years, right? So total 2,30,000 rupees of interest. However, since this amount is the interest amount that can be claimed is maximum limited to 2 lakh rupees, I will be able to reduce 2 lakh rupees, not the entire 2,30,000 rupees. Now, there is another section that comes into picture in case we have a home loan. The section is 80EEA. Now, 80EEA acts over and above section 24B that we were talking about. Under 80EA, you can have further deduction of 1,50,000 rupees. However, there are certain conditions that need to be maintained as well. Firstly, the loan should be from a bank. Secondly, the loan must be sanctioned between the period 1st April 2019 to 31st of March 2022. The value of the property, the stamp value of the property should not be more than 45 lakhs. And finally, the house property should be first house property of the taxpayer. Now, here lies another question. If, for example, I have a house which I have inherited, and after inheriting, I'm going ahead and purchasing another house, will I be able to claim 80EA? To answer, no, you will not be, because at the time of availing 80EA, it needs to be seen whether at that date you have a house property in your name or not. If you have, then you cannot claim deduction for 80EA. Moving on. Now let's talk about the deductions. Now, investment, there are certain amount we can do, right? For example, ATC. ATC is a very common instrument to save the amount of taxes. Let's talk about EPF, Provident Fund. Every month, a certain amount of money is deducted from our salary by our employer. Now, that amount is Employer Provident Fund. Further, there are two types of other provident fund. One is PPF, one other is VPF, Voluntary Provident Fund. Now, in PPF, you can invest 1.5 lakh rupees in a year, and it can go to ATC deductions. Further, VPF is also there. If you want to invest in PF voluntarily over and above PPF and EPF, you can do so by investing the sum in VPF. Tuition fee of children. Now, if your children are attending school, college, or university, you can take the benefit for their fees payment under Section 80C. However, it must be noted that the amount of benefit you can take is only for education purpose or admission purpose. If you are paying the sum towards developmental fees or donation, those amounts cannot be taken as deduction. Life insurance premium. So again, it's a very popular way to save the amount or save the taxes and making an investment. Now, if you have taken a medical insurance policy, any amount you pay to keep that policy in force can be taken as deduction. The policy can be in your name, your spouse's name, or your children's name. If you are doing that, you can take the benefit of it under Section 80C. Principal on home loan. Now we have talked about the interest component. Now let's talk about the principal component of that home loan. The principal component of a home loan can be taken as deduction under 80C. However, to claim it, the loan should be coming from a banking institute and the construction of the house must be completed. Otherwise, principal on home loan cannot be taken. However, it must be noted that in principal on home loan, for principal on home loan, there is no concept of accumulation like we have seen in interest, section 24B. So every year, if you are paying the sum, if the house is completed, then you can take it. If it is not, then it cannot be done. Thirdly, what other tax saving options are there? For saving the taxes and creating wealth is ELSS, that is equity linked savings scheme. Now, this is actually a mutual fund which has a added benefit of tax saving. The tax saving comes under 80C. However, there are certain interesting point that gives an age for two ELSS. The age is that it has a lesser lock-in period as compared to other tax saving instruments. Also, there are certain relaxation on the capital gains component in case of redemption or sale after the lock-in period is over. The tax saving FD, for example, has a lock-in period of 5 years. PPF has a lock-in period of 15 years. However, ELSS has a lock-in period of only 3 years. So you can certainly look in ELSS for tax saving. Furthermore, ELSS mutual fund, all the benefits of equity mutual fund or characteristics of equity mutual fund are attributable to it as well. Therefore, just like equity linked or equity mutual fund, any gain over 1 lakh rupees becomes taxable, and the tax is also at a lesser rate of 10%. For the tax saving FD, it's pretty much normal like any other FDs, but it has a lock-in period of 5 years. However, the interest earned on tax saver FD is taxable. The other instrument that falls under 80C is Sukanya Samriddhi Yojana. If you have a girl child, then most definitely you can look to invest in SSY. You can start investing as soon as the girl is born, and you can invest the sum till she attains majority. And once she attains majority, you can use the amount to educate further, right? Aid her in higher education. National Savings Certificate is another good and safe option to save the taxes, as well as post office deposit scheme. The other investment option are 80CCC, which is your pension plan. You can go ahead and pick up a pension policy, and whatever amount you are contributing towards it can be taken as deduction under 80CCC. Now, there is one particular section, that is 80CCD 1, 2 and 1B, which needs to be understood conjointly. Now, normally, if we are investing in NPS, then the entire amount goes towards ATC deduction. However, if we are investing in NPS along with all other tax saving instrument, then I can take the benefit of investing in NPS over and above normal deduction limit of 80C. Let's try to understand with an example. Let's say my salary has PF deduction. I have also invested in SSY and ELSS and everything, and that is eating up my ATC limit. Now, at this point of time, if I invest in NPS, then I can get additional deduction by the virtue that I have invested in NPS. Now, with numbers, we are going to look at it at a later point. Now, another talking point is employer contribution to NPS. Now, some of the employer allow to invest in NPS through them, and maximum 10% of the salary can be invested in NPS. Now, salary in this context means the basic salary. However, there is a certain limit within which you need to be investing. Otherwise, the excess contribution in NPS will be taxable. That limit is 7.5 lakh rupees. Now, having seen the tax saving instruments and tax saving expenses, let's try to understand the antithesis of all these things. That is the new tax regime. Now, new tax regime does not allow you to take any benefit of these tax saving instruments. However, it gives you the benefit of lesser rate of taxes. But we, in our experience, have seen not many people opting for the new tax regime. Why? Because from our childhood days, we have seen our parents investing and saving the taxes, and that has been ingrained in us from our very childhood. Therefore, any people who are just getting into a job, employment, they start considering about investing. The instrument may have changed over the time, however, the mentality has not changed. Now, let's try to understand whether the new tax regime is beneficial for you. In short, we are going to compare the new tax regime and the old tax regime to get a better understanding. Now, for this purpose, we have taken an example of a sample salary. The sample salary is 10 lakh rupees, which is broken down in basic, HRA, and other allowances. The basic being 50% of it, that is 5 lakh rupees. HRA is 2 lakh rupees, and other allowances 3 lakh rupees. And in this example, we have taken that the person is staying in a place in Bangalore and paying 20,000 rupees of rent per month. That is 2,40,000 rupees in a single year. Now, under the new tax regime, since there are no deductibles, the 10 lakh rupees salary will become taxable in my hand as 10 lakh rupees. Excuse me. Under the old tax regime, I will be able to take HRA allowance, I will be able to take standard deduction and professional taxes if I have paid any. Now, over here we can see that HRA deduction is coming to 1,90,000 rupees. However, the rent that I have paid is only 2,40,000 rupees. Now let's try to understand whatever we have discussed in HRA. Let's try to recapitulate. We have mentioned that to get the HRA exemption, we need to see three figures. One is 40 to 50, 40 or 50% of the basic. Number two is the HRA that I am getting. And number three is rent paid minus 10% of the basic. Now, 40 to 50% of the basic, that actually depends on the city that I'm staying in. If I'm staying in Delhi, Mumbai, Kolkata, or Chennai, then 40% basic will be applicable for me. Otherwise, 50% of the basic in case of Delhi, Mumbai, Chennai, and Kolkata. All the other cities, 40% of the basic. Now, in this scenario, the amount of rent that I'm paying is 2,40,000 rupees. From there, we will be reducing 10% of my basic amount, that is 50,000 rupees, which will give me 1,90,000 rupees. 40% of the basic again is 2 lakh rupees, and HRA component is again 2 lakh rupees. So the lesser amount is 1,90,000. Therefore, I will be reducing 1,90,000 rupees. From there, standard deduction of 50,000 rupees will be applicable, which is given to every salaried individual. And from there, if any, provisional taxes or tax on employment, which would give us a total salary of 7,57,000 rupees as compared to 10 lakh rupees under the new tax regime. From this amount, we need to reduce all my ATC, the tax saving investments. In this instance, LIC is 50,000 rupees, ELSS 25, SSY 30,000 rupees, EPF and all. After all this deduction, my total taxable salary is coming to 6,19,000 rupees as compared to 10 lakh rupees under the new tax regime. Now, if we look at the tax computation under the new tax regime, up to 2,50,000 rupees, there is no taxes. From 2,50,000 to 5 lakh rupees, the rate of tax is 5%, which will give me 12,500 rupees. Now, from 5 lakh to 7 lakh rupees, under the new tax regime, the rate of tax is 10%, which would give me 25,000 rupees. And 7 lakh 50 to 10 lakh rupees, the rate of tax is 15%, which would give me a tax of 37,500 rupees. All in all, 75,000 rupees will be the tax payable. And on top of that, we will be adding 4% of health and education cess. And the amount of tax that needs to be paid will be 78,000 rupees. Now, if we come to old tax regime, again, up to 2,50,000 rupees, the rate of tax is nil. Therefore, no tax need to be paid. From 2,50,000 to 5 lakh rupees, the rate of tax is 5%, which would be 12,500 rupees. And beyond 5 lakh rupees, there is an increment of only 1,19,000 rupees, for which I need to pay tax at the rate of 20%, which would be 23,800 rupees. In total, the income tax would be 36,300 rupees. And if we add in 4% of health and education cess, it will be 1,452, which will be rounded down to 37,750 rupees. And by that, we will be able to save taxes worth 40,000 rupees if we go for the old tax regime. So there is a understanding how new tax regime and old tax regime fare against each other. Now again, we can take maximum 1,50,000 rupees of deduction under ATC. However, if we are investing in NPS, National Pension Scheme, we can save another 15,000 rupees of taxes just because we have invested in NPS. Now, for this purpose, we have assumed that the effective tax rate for you is coming to 30% and 4% on the education cess on the tax amount. In the earlier example, we have already exhausted 1,50,000 rupees. Now, if I am investing in NPS as well, then I will be getting the benefit of investing in NPS. However, the amount will be limited to 50,000 rupees. And by that, I will be able to save another 15,000. Now, going beyond ATC. Beyond ATC, you can save the taxes under ATD, which is the second most popular category for saving the taxes. Section 80D actually talks about health insurance premium paid and preventive health checkups. Now, if you are entire benefit, if you are a if your parents are also dependent on you and they are not senior citizen, you can take maximum up to 25,000 rupees as well. However, if your parents are senior citizen, in that case, the premium amount extends to 50,000 rupees. And if you are senior citizen, then also it is extended to 50,000 rupees. Now, in case the taxpayer's parents are not covered under any medical insurance, then medical expenses up to 50,000 rupees can be claimed instead of medical insurance. But make sure your parents are not covered under any medical insurance, be it a group policy, be it an independent policy taken by you, or any policy extended by the employer. If they are covered under any medical insurance, then medical expenditure cannot be taken. The other section of deductions are ATDD, which actually talks about if any dependent of the taxpayer is differently abled. If the disability level is more than 40% but lesser than 80%, in that case, if the maintenance you can claim up to 75,000 rupees. If the disability limit is more than 80%, then you can claim maintenance of 1,25,000 rupees. If any dependent on you are suffering from any specific diseases, for example, motor neuron diseases like Parkinson's or any other severe diseases like cancer, etc., etc., for them, medical expenses or 40,000 rupees, whichever is lesser, can be taken as deduction. In case they are senior citizen, maximum up to 1 lakh rupees can be taken. If the taxpayer himself or herself are differently abled, then if the disability limit is more than 40% but lesser than 80%, 75,000 rupees can be claimed. If it is more than 80%, then 1,25,000 rupees can be claimed. Interest on education loan, if the taxpayer or any dependent of the taxpayer has taken a education loan for higher education, that is beyond bachelor degree, in that case, any amount of interest that you have paid can be taken as deduction. And if you are contributing in charities, then that donation or a certain part of that donation can be deductible. Most of the charities give you the benefit of 50% deduction. Some of the other charities give you 100% deduction. For example, PM Cares Fund, it actually gives you a benefit of 100%. Now, we are coming to the end of the session, and at this point of time, we are going to talk about certain items that we need to be keeping in our mind. Firstly, at the beginning of the year, we are supposed to declare our tax saving investment and choose the tax regime that we are supposed to be paying the taxes. However, in the middle of the year, it is not possible for us to switch between the regimes. However, at the time of filing the income tax return, it is quite possible to choose between the new tax regime or the old tax regime. So if you have chosen incorrectly at the beginning of the year, you still have another option to go with the most beneficial regime for you. Second point is, you should be looking to submit proof for all the investment declaration you have made at the beginning of the year. Now, your employer, for this purpose, acts as agent of the government. It is their job to verify the documents and based on the document, they are supposed to compute the taxes and withhold the taxes. Now, if you are not submitting any proof, your employer will ignore whatever the declaration you have made at the beginning of the year and compute the taxes. Therefore, if you are not submitting proofs, then you can see a huge amount of tax outflow in the last few months of the financial year. However, it's nothing to be afraid of, because if you have paying extra amount of taxes in last few months, you will be getting a refund once you submit all the documents, or rather once you factor in all the documents at the time of filing your income tax return. So if you have missed out an opportunity to take benefit of tax saving investment, it will present itself again at the time of filing the income tax return. And finally, many of us are changing the job during the year, right? Now, once you are changing the job during the year, please make sure you're declaring your previous employer's salary and tax to your present employer, and make sure those information are factored in tax computation of the new employer as well. Because if you do not do that, your employer thinks that this is the first employment of the year you are getting, and they give you benefit of 80C, 80D, basic exemption, standard deduction all over again. One key thing to look out for is, usually whenever you are switching the job, it is for a hike, right? Now, if you are switching job for a hike, then most definitely be your tax outflow will be also higher. So till this point of time, your salary was 10 lakh rupees, and every month tax deductible of 7,000 rupees was happening. Now you switched the job in the month of December for 15 lakh rupees, right? Therefore, your salary has risen 50%. Therefore, your tax payable should also be rising, right? However, you notice that for December, January, and for December month and January month, no tax has been deducted, right? Which should be a which should be a red flag for you, because you have switched the job for a hike. Therefore, the tax payable and tax deductible should also be higher. If this is not happening, then you should bear in mind there might be some inaccuracy going on. So if this is happening, contact your HR team or payroll team, whosoever in charge, and explain the situation to them. And make sure you are including previous employment's earning in the current employer's earning as well. If you do not do that, at the time of filing your income tax return, you can see a huge amount of tax payable coming in your way, along with some interest as well. Therefore, if you are switching the job, be very, very, very careful about it. Now, we are at the end of our session, and we will be opening the floor for question and answer. If you do have the questions, please drop a note. Right. If no questions are coming along, then we might as well as call it a day. Thanks for joining with us. Have a great day and have a great weekend. Bye bye.